Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about ZHONGYU Energy interim report. ZHONGYU Energy Holdings Limited offers a diverse range of businesses and services across the energy sector. The company's key areas of operation include natural gas projects development and construction, gas pipeline infrastructure investment, operation and management, piped gas distribution to residential, industrial, and commercial users, smart energy development, compressed natural gas and liquefied natural gas vehicle, filling stations, operation, sale of various gas-related equipment and appliances. Additionally, the company provides services in renewable energy provision, trading of natural, coal, and liquefied petroleum, gas property management, digital and information technology development, and consultancy, engineering projects, budgeting, consultancy, management services. ZHONGYU Energy's stock price has dropped approximately 27.98% over the past year due to several key factors. One major contributor is significant margin compression and profit decline, with a gross profit ratio decrease from 19.3% in 2021 to 13.1% in 2024, resulting in a nearly 90% net income drop. Additionally, persistent overvaluation has been a concern, with the company's price-to-earnings (P/E) ratio remaining more than 5 times the peer average since 2021. Declining free cash flow and decreased turnover have also negatively impacted the stock price, with a 9.4% fall in turnover in HON 2025. Furthermore, reduced net income and profit margins, high debt levels, low return on equity (ROE), and poor interest coverage have all contributed to the decline in ZHONGYU Energy's stock value. These financial indicators suggest that the company is facing significant challenges in maintaining profitability amidst market volatility and competitive pressures within the energy and utilities sector. The primary drivers of revenue growth or decline in the company's financial performance can be attributed to a few key factors. On the negative side, decreases in sales of gas, -3.7%, gas pipeline construction, -34.6%, smart energy, -39.5%, and value-added services, -10.8%, have contributed significantly to revenue decline. Specifically, sales of gas decreased by 4.1%, while smart segment revenue and value-added energy services segment revenue declined by 39.4% each. On the positive side, there are some slight increases in certain segments, including a 6.2% increase in units of natural gas sold to vehicles and a 1.7% increase in total length of existing intermediate and main pipelines. However, these growth drivers do not seem to offset the significant declines in other areas, resulting in overall revenue decline. Net income and profit margins. A shift in trends. The financial summary reveals a mixed bag of changes in net income and profit margins for the company. On one hand, net income saw an increase of $180,888,000 on page 31 due to other net gains, and a further increase of 2.7% to $145,510,000 on page 32. However, it decreased by 37.4% for gas pipeline construction on page 29. Profit margins also experienced fluctuations across different segments. The gross profit margin remained relatively stable at 75.7% on page 29, but declined to 12% on page 31. In contrast, the smart energy segment saw an increase in profit margins from 10.2% to 14.4%, while value-added services experienced a significant jump from 80.2% to 88.2%. On the other hand, CNG/LNG in vehicle filling stations witnessed a decline in profit margins from 2.8% to 1.1%. The reasons behind these changes are not explicitly stated, but they suggest that the company is shifting its focus towards more profitable segments such as smart energy and value-added services. The decrease in gross profit margin on page 31 may be attributed to increased competition or operational inefficiencies. Overall, the financial summary highlights the need for closer examination of each segment's performance to understand the underlying drivers of these changes. The company's financial performance indicates a consistent generation of positive operating cash flow. The data from 2024 and 2025 shows that the company has been able to generate significant amounts of cash from its operations, with $233,419 in 2024 and $143,140 $111 in 2025. This trend suggests that the company's business model is financially sustainable and capable of producing positive returns on investment. The company's financial performance was mixed across various segments. The gas, smart energy, value-added services, CNG/LNG sales of gas, and smart services segments all showed strong performances, contributing to the company's revenue and profit growth. In contrast, the gas pipeline construction and vehicle filling stations segments struggled, indicating areas that require improvement. Management's outlook on company strategy: the company's management is focused on maintaining a stable financial position. They will continue to monitor cash flow and debt levels, seeking cost-effective financing options. Additionally, there are currently no plans for significant investments in new capital assets or material projects. This cautious approach suggests that the company is prioritizing financial prudence over aggressive growth strategies. The company has a history of distributing wealth to its shareholders through two primary means. Firstly, it has paid dividends in the years 2024 and 2025, totaling $321,321,000. Secondly, it has also repurchased shares from the market, with transactions recorded at 30th June 2024 and 2025. That concludes the financial summary for ZHONGYU Energy. Feel free to comment below, and I will be happy to answer them when possible.